$1,000 silver sounds impossible until you ask who is buying and why they're buying together. What if the price of silver is no longer set by traders, but by governments? What if the biggest buyers in the market don't care about volatility, don't care about pullbacks, and don't care about price at all? 50 nations, coordinating purchases, outside the exchanges, outside the public spotlight. While most investors are still watching charts, something far more important may already be happening behind closed doors. This is not about speculation. This is not about returns. This is about control of supply, of settlement, and of who gets the medal when it matters most. If silver is quietly becoming strategic, if governments are positioning before the public understands why, then the real question isn't how high silver can go. It's what breaks first when the market realizes the supply is already spoken for. Welcome to Boring Currency Reports. If you've been watching quietly, thinking carefully, and you prefer understanding systems instead of chasing headlines, then you already belong here. Do us a favor. Subscribe the way you would shake hands with an old friend you trust. Slowly and with intention. And tell us in the comments, from where in the world are you watching this unfold? At first glance, the silver price appears to be the story. Numbers move, headlines react, commentators debate targets. Yet price is not the event. It is only the visible signal of deeper changes taking place beneath the surface. They have seen this pattern many times before. When markets go through structural change, price is always late. Behavior changes first. Who buys, how they buy, why they buy. Those shifts happen quietly, often ignored, until price is forced to respond. Silver's recent movement has attracted attention, but movement alone explains very little. Prices can rise because of speculation, short covering, inflation fears, or currency weakness. These explanations feel familiar, and familiarity creates comfort. But comfort is dangerous when markets are transitioning. Serious analysis begins by asking a different question. Not how much did the price move, but what changed underneath the market to make that move possible. In most markets, price is set by buyers who care deeply about price. If prices rise too quickly, demand falls. If prices drop, demand returns. This feedback keeps markets balanced. It assumes that buyers are flexible. That assumption does not always hold. Silver occupies a rare position. It is both an industrial necessity and a monetary asset. It is consumed in manufacturing and stored as value. Very few materials play both roles at the same time. This matters because it changes how demand behaves during stress. Industrial systems do not pause because prices rise. Power grids, medical equipment, electronics, and defense systems require silver regardless of cost. These sectors buy because they must operate. At the same time, monetary demand increases when confidence in paper systems weakens. That demand seeks certainty, not yield. When both forces act together, pressure builds. For years, this pressure was hidden by paper markets. Futures contracts and financial instruments expanded the appearance of supply. Most trading occurred without delivery. As long as trust remained, the system worked. But trust is not permanent. They are now seeing signs that confidence is being tested. These signs do not appear on charts. They appear in policy language, procurement behavior, and who is stepping into the market with long-term intent. Governments do not behave like traders. They do not buy because price looks attractive. They buy because availability matters. When a government classifies a material as important for security or stability, price becomes secondary. That single shift changes the market. When buyers stop caring about price, higher prices no longer reduce demand. In fact, they can increase urgency. Buyers move early to avoid future restrictions. This behavior breaks traditional models. Silver is vulnerable to this shift because supply cannot respond quickly. Most silver is mined as a byproduct. Production does not surge simply because prices rise. This limits flexibility. At the same time, much of the silver used in industry is never recovered. It disappears into infrastructure and products. That supply does not return to the market. This creates a quiet tightening. Price does not immediately reflect this reality. Price reacts only when access becomes visibly constrained. By then, the structure has already changed. They are not observing a normal bull market. They are observing the early stages of a potential regime shift, where silver moves from a traded commodity into a strategic asset. Such transitions do not announce themselves loudly. They unfold through behavior before they appear in price. The price is not the story. It is the message. And in markets like this, the message always arrives after the decision has already been made. The meaning of coordination. When markets are no longer free. Most people hear the phrase international coordination and assume it means discussion, alignment, or symbolic cooperation. In markets, that assumption is dangerous. Coordination is not conversation. Coordination is action taken together, at scale, with intent. They understand this difference very well in government and policy circles. When nations coordinate around a commodity, it usually happens for one reason only. The market is no longer trusted to deliver stable outcomes on its own. Free markets work when supply is reliable, incentives are aligned, and participants believe prices reflect reality. Coordination appears when those conditions break down. This is why the idea of dozens of nations acting together in a single market deserves careful attention. It signals that something fundamental has changed in how the market is perceived. In normal conditions, governments prefer markets to do the work. Markets allocate resources efficiently, or at least cheaply. Intervention costs political capital and money. It also admits failure. Governments do not intervene unless the risk of not acting becomes greater than the cost of acting. When coordination emerges, it means multiple governments have reached the same conclusion independently. Access matters more than price. This is the core shift. A coordinated purchasing framework does not behave like market demand. It does not chase dips or sell rallies. It sets targets, volumes, timeframes. It locks in supply through agreements rather than exchanges. Once these frameworks are active, the commodity stops flowing freely. The difference between buying on an exchange and buying through direct agreements is critical. Exchanges are designed for liquidity. They assume sellers will always exist at some price. Direct agreements assume scarcity and prioritize certainty over efficiency. Governments choose certainty. They do this because they plan for scenarios markets cannot price properly. Supply disruptions, geopolitical stress, infrastructure buildouts, defense needs. These factors do not respond to price signals in neat ways. When many governments coordinate, they are not trying to outbid one another. They are trying to prevent competition between themselves. That is often misunderstood. Coordination reduces internal conflict and increases external pressure. Instead of 50 buyers competing in open markets and driving prices violently higher, they act together to secure supply quietly and early. This behavior removes material from circulation before the public sees the shortage. History offers many examples. Energy markets during embargoes, agricultural stockpiling during food crises, strategic metals during military expansion cycles. In every case, coordination preceded repricing. Silver now appears in the same category. What makes silver different is its size. The market is relatively small compared to the scale of global capital. It does not take massive allocation shifts to change its structure. Modest, coordinated demand can overwhelm available supply without dramatic headlines. This is why coordination matters more than speculation. Speculators react to price. Coordinators react to risk. One chases opportunity, the other avoids vulnerability. When governments coordinate, they usually do so quietly at first. Public announcements come later, often after positions are already built. This protects the program and avoids triggering panic or political backlash. Markets often misinterpret this silence as inactivity. But silence in policy is rarely empty. Another important element is duration. Coordinated frameworks are not temporary trades. They are multi-year or multi-decade programs. Once established, they create baseline demand that does not disappear during downturns. This changes volatility. It also changes expectations. Producers respond differently when buyers are permanent. Refiners prioritize long-term contracts. Logistics adjust. Inventory is held back rather than offered. The spot market becomes thinner. All of this happens before price reflects the shift. Critically, coordinated buyers are not constrained by performance metrics. They do not need justification every quarter. They do not exit positions because sentiment turns negative. Their mandate is continuity, not return. This creates an asymmetry. Private participants remain price sensitive. Governments do not. Over time, this imbalance forces repricing or forces failure somewhere in the system. Silver's role in industry amplifies this effect. Industrial users cannot simply stop buying when prices rise. Governments cannot accept supply insecurity. Together, these forces tighten the market from both ends. The idea that coordination will cap prices misunderstands the objective. Coordination is not price control in the retail sense. It is supply control. And supply control almost always leads to higher prices once the reality becomes visible. By the time markets recognize that coordinated buyers exist, the free float is already smaller. This is why analysts who focus only on charts and forecasts miss the point. Coordination does not show up in technical indicators. It shows up in availability, delivery timelines, and policy language. They are not witnessing a bullish narrative. They are witnessing a defensive posture adopted by states that no longer trust the market to provide what they need on demand. That posture does not unwind easily. When coordination replaces competition, the market is no longer discovering price. It is rationing supply. And when rationing begins, the story is no longer about whether prices rise, but about who gets access at any price at all. Why silver stands alone in a world that needs certainty. In global markets, not all metals are equal. Some are abundant, some are replaceable, some serve a single function and can be swapped out when conditions change. Silver does not belong to that group. It occupies a narrow and uncomfortable position that few assets share. They often describe silver as both an industrial metal and a monetary asset, but that description understates the problem. Silver is not simply used in industry while also being stored. It is consumed by industry while being hoarded for security. These two forces normally do not coexist in the same material. This is what makes silver structurally fragile. Industrial demand does not pause during uncertainty. It accelerates. Electrification projects continue. Medical systems require reliable inputs. Defense manufacturing expands during periods of geopolitical stress, not calm. These sectors do not negotiate with the market. They place orders because operations depend on delivery. At the same time, monetary demand behaves in the opposite direction. When uncertainty rises, people and institutions seek assets that do not depend on promises. They move away from abstractions and toward tangible stores of value. Silver has historically played that role, especially when confidence in paper instruments weakens. Most commodities face one type of demand pressure at a time. Silver faces both. This dual demand would be manageable if supply were flexible. It is not. Silver is primarily mined as a byproduct. Its production depends on the mining of other metals like copper, lead, and zinc. Even if silver prices rise sharply, production cannot increase quickly unless those other metals are also in demand. This delays supply response. Time matters in markets. Delayed supply creates vulnerability. They also observe that silver is consumed in very small amounts across millions of applications. Once used, it is rarely recovered. This is different from gold, which is almost always recycled. Industrial silver disappears into landfills, electronics, and infrastructure. This creates a one-way flow. When a metal is both consumed and stockpiled, the available pool shrinks from both ends. One side removes supply permanently. The other removes it for decades. The market becomes thinner even if headline inventories appear stable. This is why silver behaves differently under stress. There's also a misconception that industrial users can substitute away from silver when prices rise. In theory, substitution exists. In practice, it is slow, expensive, and often impossible at scale. Performance, conductivity, and reliability matter more than cost in critical systems. Substitution happens at the margins, not at the core. Defense systems, medical equipment, and power infrastructure do not redesign themselves because of price fluctuations. They are built for function, not efficiency. Silver's properties are not easily replaced without compromising performance. This locks in demand. At the same time, silver's monetary role gives it optionality. It does not need industrial demand to justify its value. It can stand on its own as a store of purchasing power. This creates a floor beneath the market that most industrial commodities do not have. When trust erodes, that floor rises. They also note that silver's market is relatively small. Compared to global equity markets, bond markets, or even energy markets, silver is shallow. It does not take large shifts in allocation to overwhelm available supply. A small reallocation from large entities can change everything. This is why silver attracts attention during periods of systemic stress. It is not because of speculation. It is because of its position at the intersection of necessity and trust. Governments understand this intersection. Industrial planners see silver as an input risk. Monetary planners see it as a confidence signal. When both perspectives converge, silver stops being just another commodity. It becomes strategic. Once an asset is classified as strategic, the logic of the market changes. Availability becomes the primary concern. Cost becomes secondary. Stockpiling becomes rational. Intervention becomes acceptable. This shift does not reverse easily. They are not dealing with a temporary shortage or a cyclical upswing. They are dealing with a metal whose demand profile is tightening structurally while its supply profile remains constrained. This creates a slow building pressure rather than a sudden shock. The danger for market participants is assuming that silver behaves like other metals. It does not. It does not respond predictably to price. It does not flood the market when prices rise. It does not lose relevance when economic conditions weaken. Instead, it becomes more important. Silver's uniqueness is not about hype or history. It is about function. It does things other materials cannot do at scale, and it does so in systems that governments cannot afford to disrupt. This is why silver is increasingly discussed not as an investment, but as an input, a reserve, and a safeguard. And once a metal enters that category, its price stops being negotiated by the market alone. It is dictated by necessity. Markets are built on a simple idea. Buyers and sellers meet, and price balances their interests. This works only when both sides respond to incentives. When buyers hesitate at higher prices, markets cool. When prices fall, buyers return. This rhythm creates stability. That rhythm breaks when the buyer no longer cares about price. They define the most important participant in any market as the marginal buyer. This is the buyer whose actions determine the next price. For decades, silver's marginal buyers were traders, funds, industrial users, and retail investors. All of them were price sensitive. That is no longer guaranteed. When governments enter a market as consistent buyers, they do not behave like participants. They behave like planners. Their goal is not profit. Their goal is continuity. This single difference reshapes the entire structure. A government does not wait for a dip to secure supply. It buys because it must. It does not sell into strength. It holds because liquidation defeats the purpose of reserve building. Once the allocation decision is made, execution becomes mandatory. This creates demand that does not retreat. They also note that government demand is not subject to fear. There are no margin calls, no redemption requests, no quarterly reporting pressures. Political accountability exists, but it operates on much longer timelines. Time horizon matters more than capital size. When long horizon buyers accumulate in a small market, the available supply shrinks quietly. There is no sudden shortage announcement. There are simply fewer offers at prevailing prices. Sellers become cautious. Inventory moves into vaults and does not return. This is how markets tighten without warning. Another difference lies in the way governments buy. They do not rely on exchanges designed for speculation. They prefer direct relationships with producers, refiners, and primary distributors. These channels bypass visible price discovery. When demand shifts off exchange, the exchange price becomes less representative. This creates a divergence between what the screen shows and what is actually available. Delivery times lengthen, premiums widen, the physical market begins to ration supply. They have seen this pattern in other sectors: energy contracts during supply shocks, food grains during export restrictions, medical equipment during crises. The common factor is always the same. Once governments become buyers, the market stops clearing smoothly. Silver is vulnerable to this dynamic because of its scale. It does not have deep buffers. Inventory is finite and often already allocated. When a portion of that inventory is removed for strategic purposes, the remaining float becomes fragile. This fragility is not immediately visible. Traders may continue to trade contracts. Prices may still fluctuate within ranges, but underneath, the system becomes dependent on confidence rather than abundance. Confidence is a weak foundation. They also recognize that once governments establish silver as a reserve or strategic asset, the signal spreads. Other institutions adjust. Pension funds reconsider exposure. Industrial users seek longer-term contracts. Everyone moves to secure access. This is how marginal buying expands beyond its original source. Importantly, this process is not driven by excitement. It is driven by risk management. No one wants to be last when supply tightens. Early movers absorb cost to avoid uncertainty later. As this behavior spreads, price sensitivity erodes further. At this point, traditional price suppression mechanisms lose effectiveness. Selling pressure from speculative accounts cannot offset persistent accumulation by non-selling entities. Volatility may increase, but direction becomes harder to reverse. This is not a bubble dynamic. Bubbles depend on leverage and fragile sentiment. Structural accumulation depends on policy and necessity. They also understand that governments rarely reverse strategic decisions quickly. Once infrastructure, legal frameworks, and storage systems are built, unwinding becomes politically and logistically difficult. This locks demand in place. The silver market was not designed for this kind of buyer. It evolved around financial liquidity, not strategic hoarding. When that mismatch becomes large enough, the system adapts in one of two ways: repricing or breakdown. Repricing restores balance through higher prices that ration demand. Breakdown occurs when settlement mechanisms fail and confidence collapses. Both outcomes favor holders of physical supply. This is why the entrance of price-insensitive buyers matters more than any forecast. It changes the rules of the game. When the buyer no longer cares about price, price must eventually move to reflect scarcity. And by the time that move becomes obvious, access is already gone. Modern commodity markets are built on trust. Most participants never expect to take delivery. They trade contracts, not materials. This works only as long as everyone believes delivery could happen if needed. The moment that belief weakens, the structure becomes unstable. They are now approaching that moment. Paper markets were designed to create efficiency. Futures contracts allow producers to hedge and buyers to plan. But over time, these markets grew far larger than the physical supply they represent. Contracts multiplied. Leverage increased. Settlement became mostly financial rather than physical. As long as physical demand remained moderate, this imbalance did not matter. But when physical demand tightens, paper markets are tested. Silver is especially exposed because of its size and structure. The volume of paper claims far exceeds the amount of metal readily available for delivery. This is not unusual in itself. What is unusual is what happens when more participants begin to care about delivery rather than exposure. Delivery changes behavior. When buyers insist on physical settlement, the system must either source the metal or offer cash instead. Cash settlement preserves the system but breaks the promise. It confirms that the paper contract is not equivalent to the asset itself. This distinction matters more during periods of stress. They observe early signs of strain in how silver trades. Physical premiums rise, even when paper prices stall. Delivery times lengthen. Refiners prioritize long-term clients over spot buyers. These are not anomalies, they are rationing signals. Rationing is the market's way of admitting scarcity without saying it directly. Another warning sign appears when near-term physical supply becomes more valuable than future promises. This condition, known as backwardation, reflects urgency. It suggests that buyers prefer metal now rather than later, even at a higher cost. Markets do not enter backwardation casually. Backwardation does not mean collapse is imminent. It means confidence is being tested. It means the market is beginning to price time risk and delivery risk, not just price risk. This shift often goes unnoticed because it does not create dramatic headlines. They also see stress and arbitrage. In theory, price differences between paper and physical markets should close quickly. In practice, logistics, regulation, and policy barriers prevent easy movement of metal. Taxes, export controls, fabrication limits, and political priorities all interfere. When arbitrage fails, price stops being universal. At that point, there is no single silver price. There's a screen price and a real-world price. The gap between them reflects trust. This gap widens when physical metal becomes strategic. Governments and large institutions do not rely on exchanges during stress. They secure supply through direct contracts. This removes metal from circulation without affecting paper volume. The paper market continues to trade, but with less backing. This creates a hollowing effect. They are not suggesting that paper markets disappear overnight. They persist because they are useful. But their role changes. They become reference points rather than sources of supply. The danger for participants is assuming that reference prices guarantee access. When access becomes uncertain, behavior changes rapidly. Industrial users increase inventory. Investors seek direct ownership. Institutions reassess counterparty exposure. Each action reinforces the next. This feedback loop tightens physical supply further. Another overlooked factor is the role of clearinghouses. These institutions exist to prevent systemic failure. When stress rises, they prioritize stability over price accuracy. This can mean higher margins, restricted trading, or forced cash settlement. These actions protect the system, not individual participants. In such environments, paper holders may find that outcomes differ from expectations. Contracts are honored, but not always in the form assumed. Value is preserved in nominal terms, but purchasing power may be lost if prices reprice outside the system. Physical holders face a different reality. They are outside the clearing mechanism. They are not dependent on settlement terms or counterparty decisions. Their risk is storage and security, not default. This difference becomes critical during structural shifts. They emphasize that this is not about panic. It is about understanding how systems behave under pressure. Paper markets are efficient in normal times. Physical control matters in abnormal times. Silver now sits at the edge of that transition. As governments, industries, and institutions compete for supply, the paper system is asked to do something it was not designed to do: guarantee access in a world of scarcity. It cannot. When that realization spreads, adjustments happen quickly, not because of fear, but because of logic. Markets always reveal their true structure when tested, and silver is now being tested at the point where paper promises meet physical limits. When a market changes structure, the consequences extend far beyond price. They reshape capital flows, policy decisions, and business strategy. Silver is now entering this phase, where its role in the global system begins to shift from optional to essential. They understand that silver does not compete with other commodities alone. It competes with financial assets. Every unit of capital directed toward physical silver is capital not directed elsewhere. This matters most in an environment where governments and institutions are questioning the reliability of traditional stores of value. For decades, sovereign debt served as the default reserve asset. It was liquid, trusted, and backed by political authority. That trust is now under review. Rising debt levels, persistent deficits, and expanding monetary intervention have changed how reserves are evaluated. Silver enters this discussion not as a replacement for debt, but as a hedge against its limitations. When governments and institutions allocate even a small portion of reserves to physical assets, the impact on silver is disproportionate. The market is too small to absorb large flows without repricing. This makes silver a signal asset. Its movement reflects broader concerns about confidence and stability. They also recognize that policy alignment matters more than forecasts. When laws, regulations, and strategic frameworks move in the same direction, markets follow. Silver's inclusion in supply chain security, defense planning, and reserve discussions signals that policy support is forming. Policy support changes risk calculations. For businesses, this creates a new operating environment. Companies that rely on silver as an input must plan for availability, not just cost. Just-in-time procurement becomes riskier when supply is politically prioritized. Inventory strategy becomes a competitive advantage. Firms that understand this early secure contracts, diversify suppliers, and adjust pricing models. Firms that ignore it face disruption. For investors, the lesson is not to chase price, it is to understand positioning. Structural shifts do not reward speed, they reward foresight. Assets that move from financial instruments to strategic resources behave differently under stress. They caution against linear thinking. Markets do not transition smoothly from one regime to another, they move in steps. Long periods of apparent calm are followed by sudden adjustments. These adjustments feel chaotic only to those who did not see the structure changing. Silver's future is not defined by a single price target. It is defined by its role. When an asset becomes essential across multiple systems, it stops being valued solely by supply and demand curves. It is valued by its function within those systems. This is why predictions matter less than preparation. Governments are not speculating. They are positioning. Industries are not betting. They are securing. Institutions are not trading. They are reallocating. These actions signal a shift in priorities. They also note that markets rarely reverse structural changes quickly. Once new frameworks are built, unwinding them requires political consensus and economic stability. Both take time. During that time, the new structure governs behavior. Silver structure is becoming more rigid, not more flexible. The most important takeaway is not fear or excitement, it is clarity. The silver market is no longer driven solely by price discovery. It is increasingly influenced by policy, security, and long-term planning. This does not mean free markets disappear. It means they coexist with strategic intervention. In such environments, traditional assumptions fail. Those who adapt their thinking gain resilience. Those who rely on old models face surprises. They conclude that silver's repricing, if it occurs, will not be gradual. It will reflect a catch-up to realities that have already been in place. By the time the adjustment is obvious, the opportunity to position calmly may have passed. This is not a call to action. It is a warning about structure. Markets speak through behavior long before they speak through price. Silver is speaking now through who is buying, how supply is treated, and how policy is aligning. The question is no longer whether silver matters. The question is whether decision makers are prepared for a world where it matters more than they expected.